millions of data points for us every month. It's too good. It's like having the talent of a CFO multiplied by 1,000. And Papaya ensures full compliance with every country's employment laws. And you know what the best part is? That even at times of market turbulence, payments run smoothly with Papaya Global. This analogy is almost as good as the real thing. Payroll and payments, one platform.
But essentially, a lot of investors out there deciding whether the chances of a soft landing would be possible. One in the no camp this morning is the Apollo Global Management co-president, James Zelter. Now, he spoke to us essentially at a Bloomberg credit conference in London overnight, and he told us that he doubts whether the Fed is going to be able to engineer a landing with just a few bumps. And the reason he says that is because Fed policy, we know that operates with a lag. The question, of course, is how long it takes to play out in the economy. All of these hikes that we've seen from policymakers there. He says that actually this time around it's going to take longer than other points in the past. He spoke to us as well about how investors can really navigate these changing dynamics in the market, specifically between equities and bonds. Take a listen.
We got out of balance. For 10 years, debt was priced way too cheap. And you were forced to go into equities, and basically debt subsidized a massive amount of equity returns. And so the last 18 months, the world now has about 300 trillion in debt on 100 trillion in global economy. Those numbers are up basically doubled in the last 10 years. And when you go from 0 to basically 4 or 5%, that's 10 trillion of borrowing costs that have to be absorbed.
Belle, others are a little bit more optimistic, though.
Yeah, that's right. We heard some more positive voices coming out, still at this Bloomberg Credit Forum in London, but from the Ares Management CEO, Mike Arrighetti, and he also spoke to us as well about the outlook for private credit. He says this market could double within the space of 5 years, so reaching $3 trillion. He says there's been a really big influx of major players into the space that have been really lured by more attractive returns. But in terms of where he sees the US economy going from here and whether a contraction can be avoided, take a listen.
It's going to be there's so many countervailing things happening here, but everything that we see in our portfolio, and I think it was shared on the prior panel, particularly in the U.S. economy, that there's real fundamental strength. The consumer is weakening, but generally hanging on. Labor market is tight. And at the end of the day, we've now kind of front-loaded the curve where if we need to start cutting, we can.
Let's get more on that Bank of Japan decision coming in just a few hours' time. Our next guest has low expectations for any imminent revision of monetary policy. Takehiro Kyuchi is a former BOJ board member and now executive economist at the Nomura Research Institute. He joins us now from Tokyo. Takehiro, great to have you with us. So do you think markets investors really overdid the reaction to Governor Ueda's comments in that, now very well-known interview?
Yeah, I think that it's overstated. So in the wake of the release of the Mr. Ueda's interview article 2 weeks ago, financial market has brought forward the prediction of the timing of rate hike. Now that according to that survey, most participants expect that BOJ will increase the short-term interest rate in April of next year, and some expect that January or by the end of this year. However, I think that the BOJ is focused on that outcome of spring wage round in February or March of next year. So it is unlikely, highly unlikely that the BOJ will move before that the end of spring wage round. So I think that the April could be reasonable, but I personally expect that the timing could be delayed to the second half of the next year because of that some deterioration of the economy and financial market condition. I think it depends on that global U.S. economic situation. If that U.S. economy is slow and the speculation of that rate cut by Federal Reserve will intensify, that's caused the yen appreciation. Under that condition, I think that the BOJ is likely to postpone the timing of that rate hike. So my forecast is that the second half of next year could be a most likely timing of the BOJ's move.
The pressure in the shorter or the medium term, right? Because you've got the dollar index forming a golden cross. We're pretty close to this year's highs. If that dollar strength continues, the yen weakness continues, how do they balance? I guess I'm wondering what Governor Ueda can say today to try and support the yen a little bit, given that there is concerns about how that's eroding households and consumers' spending ability.
Okay, I think that Mr. Ueda is paying some attention to that negative impact of that weaker yen to that prices or economy. However, it is unlikely that the BOJ will change the monetary policies just to stem that yen weakenings. Instead, I think that it's possible that Mr. Ueda, kind of lip service to stop that the yen depreciation today in the press conference. For example, if that he explained that the BOJ is also sharing that concern of the weaker yen with the government, that could have an impact to the currency market and may stem that weaker yen. So that is possible, but it's not likely that the BOJ will change the monetary policies just to stem that, stop that weaker yen.
What about in order to sort of correct the bond market functioning that's been really distorted through ultra easy policy for so long?
I think that the JGB market is not distorted so much. So BOJ explained that the purpose of that YCC tweak in July is that restore that the function of that JGB market. But I think that the explanation is not necessarily true. The concern for the BOJ is BOJ have to purchase significant amount of JGB, which may expand the balance sheet of the BOJ. And in the future, that could undermine that, BOJ's profit in the future in the process of the rate hike. So that could be a big concern for the BOJ. And that's the reason why that BOJ, tweaked that YCC to reduce the risk of purchasing a government bond. Because in the previous, under the previous governors, BOJ have to try to stop that increase of long-term yield with purchasing a significant amount of JGB. I think that Mr. Ueda wants to stop and wants to reduce this kind of risk.
So, going back to where we started about waiting for the Shunto spring wage negotiations, what are you expecting there? Are we going to see this positive wage inflation that the BOJ is waiting for?
I think that the majority of the people expect a higher wage growth rate in the next spring, and that could lead to that positive spiral of price and wages, and to lead to that higher inflation rate above the 2%. But I think that this kind of expectation is too optimistic. So I expect that the wage growth rate in the spring wage round in the next year will not reach that expected level above 3%. So BOJ explained that the 3% wage growth rate could be as consistent with the 2% inflation goal. But I think that it's not likely because that the inflation rate is declining. I think that in the spring wage round, that the most important factors to determine that the wage growth rate could be inflation rate. So this year, January inflation rate in Japan was 4.2%. So under that price conditions, basic salary growth rate was around 2%. But the next year, beginning of next year, inflation rate go down to that below 2% in my expectations. So under that context, I think that basic salary growth rate could be below 2%. So it's unlikely that the basic salary growth rate may exceed 3%. So I think that the BOJ cannot declare that the 2% inflation goal will be achieved in the near future.
Takehiro, really great to have you with us as always, especially on BOJ Day. Takehiro Kyuichi, former board member of the Bank of Japan, is a current executive economist at Nomura Research Institute. Just crossing the Bloomberg now, we've got the trade numbers for New Zealand out. We do have a little bit of a miss when it comes to exports, that coming in at just shy of $5 billion for the month of August. Expectations, or the prior reading was just about 5.5 billion. Imports at 7.28 billion, stronger than we saw in the previous reading. And that leaving the 12-month year-to-date trade deficit at 15.5 billion Kiwi dollars, and that trade deficit at $2.29 billion for August. This comes as we did have the economy surprising to the upside in the recent GDP numbers, but expectations are that recessionary conditions may be soon to return later this year. More to come here on Daybreak. This is Bloomberg.
Faith's Flowers wasn't living up to its name. But now she's using Amazon Business.